Decentralized finance, the so-called Wild West of crypto, has had its fair share of "you just had to be there" moments, especially when the industry was flying. For instance, there was a time protocols were offering astronomically high annual percentage yields to attract users. During this period, it was commonplace to see yields running in the range of 4 figures or much more. Now, while some projects still offer these unrealistic returns, there seems to be a change of tactics with real yield entering the chat. Well, it wouldn't be crypto without a fancy buzzword for the trend. So in this video, we're going to be discussing the concept of real yield and more. Before we go any further, it's essential to understand how protocols were paying out these high yields in the first place. During the DeFi summer, which kicked off in 2020, Compound Finance, a lending platform, launched the Comp token to reward users for providing liquidity. This move from Compound sparked the yield farming craze, leading to more protocols mimicking the model. Higher, after all, seems better, right? Well, that's not quite the case if there is a catch. To fund these unrealistic returns, protocols put in place excessive and unsustainable token emissions. In plain terms, with high inflation. Basically, projects rewarded users with their native project tokens that do not have much of a use case. These have often been mockingly called useless governance tokens. While protocols that use this strategy for bootstrapping found success initially, for the vast majority of projects, it would prove to be unsustainable in the long run for a bunch of reasons. First, this formula would only work as long as the demand for the token increases proportionally to the new emissions. However, this is often not the case, as these tokens usually have aggressive emission schedules, making them highly or hyperinflationary. On top of that, the demand for these native tokens rapidly dwindles as they have few or no use cases, and their value quickly becomes close to worthless. Second, most users who farmed for yields were uncommitted to projects, such that they would even develop farming strategies that would involve hopping between protocols in order to get the best APY. Most of them would just farm and discard the native tokens immediately to secure their gains. Therefore, a better model had to be considered, and this is where real yield comes in. This meant scrapping the strategy of relying solely on aggressive token emissions to carve out a model that is based on a genuine and generally committed user base. In this model, yields are generated by capturing a percentage of a protocol's actual revenue, which include, but is not limited to, trading fees, interest fees, and management fees. Ideally, like in any sustainable business model, the protocol should earn more than it spends. In other words, it should earn more money from revenue than token emissions and operational costs. Let's find out how this model works by focusing on a real yield project like GMX, a decentralized spot and perpetual exchange. The protocol has 2 native tokens, GLP and GMX. The former is a liquidity provider token that is received upon users locking an asset in the GLP pool to represent their stake in the pool. GMX token, on the other hand, is the protocol's governance and utility token that offers holders an opportunity to earn income through staking. Stakers and GLP holders are rewarded with a cut of the protocol's revenue generated from the fees paid by the users every time they make a transaction. 70% of this revenue is paid to GLP holders, while GMX stakers get the other 30% paid out in ETH. This framework sets up a model that ensures constant income for GMX users as long as the protocol continues to attract people to use their platform, hence generating fees. However, GLP holders, who are the liquidity providers, are essentially in a counterparty relationship with traders, such that when the trader wins, GLP holders lose, as trader profits are paid out from the liquidity pool, meaning that in this scenario, GLP holders are the ones who suffer. Another example of a real yield project is Umami Finance, which offers automated yield farming vaults for assets like USDC, BTC, and ETH built on top of GMX. The protocol allows users to stake its Umami governance tokens to receive a share of protocol revenue in the form of ETH. The yields are funded by the fees charged for their product, and 50% is distributed to Umami holders, while the rest is routed back to the project's treasury. However, you should note that this real yield model is not bulletproof, as it also brings in a new set of challenges.
Challenge accepted.
For one, paying out a portion of revenue to users would mean less capital for the protocols to reinvest into the project. Also, as we mentioned earlier, real yield or not, the protocol should be profitable, whereby revenue generated surpasses token emissions, operating costs, and the fees paid out to users. Generally speaking, this new model pushes the industry to put out projects that provide real value to users, as opposed to incentivizing users with tokens printed from thin air. Well, this was the point of DeFi from the beginning anyway, right? To serve users better than TradFi. That said, you'd still need to look at more than just one statistic when assessing whether a protocol is healthy or not before making an investment decision. So, what other metrics do you personally consider? Well, let me know in the comments. And in the meantime, click right here to find out the most popular projects on Ethereum in 2023.